Sentiment on global growth has taken the severest knock since the global financial crisis. Mid-September data showed that Chinese industrial output grew by just 6.9% in August, down from 9% in July. That's the lowest level since 2008. Last week, data showed that German industrial output in August slid 4%, the biggest fall in 5.5 years. And earlier this week, the IMF pulled down global growth numbers for 2014 to 3.3% from 3.4% forecast in June and 3.7% forecast in April. As these data kept pouring in, commodity prices tumbled rapidly. Crude suffered the most. Crude WTI has fallen this week to $84 per barrel, down 20% since July, indicating it is in bear market terrain. Crude wasn't alone. The Reuters CRB Commodities Index too has been falling continuously since July and is down 10% in a quarter, indicating a broad skepticism over global growth.
So is the growth scare going to get worse, and will it unleash another wave of risk aversion across all asset classes? That is the question we're asking, and our guest today is someone who is eminently capable of answering that question. I have with me former chairman of Goldman Sachs Asset Management Company and preeminent economist, Dr. Jim O'Neill. Dr. O'Neill, thank you very much for joining us. Well, first up, the IMF has tweaked global growth from 3.4% to 3.3% and down from 3.7% in April. Is there a danger that they have to lower it even further?
If it's 3.3, if that's what it turns out to be, then that's not bad. That's what the world's grown at already this decade. It's what the world's grown at by most of the last 3 decades. And so it's getting a lot of negative coverage because it's a forecast that's coming down, but I don't think it's that bad. And it might well be that the IMF is going to end up being wrong. The IMF is really good at a lot of things, but forecasting the economic cycle is not particularly one of them.
At least are you convinced that global growth has troughed out and it is on the path to improving?
You know, when I look at the US and most of the big emerging economies, I think there's reasons to be optimistic. I'd include the United States, I'd include China, I'd include India, and maybe with this election I'd include Brazil, I'd include Indonesia, I'd include Mexico, and of course while Africa's got a lot of negative comments, particularly because of this very worrying Ebola problem, I'm not sure that Africa's going to be as weak as a lot of people are saying. So, you know, it may well be that is often the case that people are getting too pessimistic, and I think I saw the IMF are forecasting 3.8 for next year, which I think is not getting enough attention.
All right, let me get into the internals of those numbers. What is your own understanding or estimate of European growth? Do you see it turning the corner, or do you see it getting worse before it improves?
Listen, I think all the signals on European economic activity have been very disappointing. Of course, we've known about that for a while in some of the so-called periphery, particularly the bigger Mediterranean countries, France and Italy, but in the past fortnight the data from Germany has been especially disappointing, and if we don't have any bounce back from this last month's weak industrial production data, I think there will definitely be more downgrades. So Europe remains not only weak but getting weaker and is becoming a bit of a drag on the world.
What about China, Dr. O'Neill? That is the other area of concern. The IMF sees it delivering 7.4% growth. You think there is a chance of a disappointment that it won't even deliver 7.4?
You know, I think the mood about some parts of the so-called emerging world, including China, may have gone too negative. You know, I think China is in reasonably decent position to deliver on 7.5% GDP growth again for this year, which is what the government told us at the start of the year they wanted. And even if it's a little bit lower, then it's not a big deal, particularly when you look at the absolute size of China. China's a 9 trillion economy going on 10 trillion, so China growing by 7.5% is effectively equivalent to the United States growing by 4%.
Well, Dr. O'Neill, I'm asking you these questions on growth because of the big fall in commodity prices, especially in crude. Is the crude market signaling a steeper fall in global growth, or are crude prices falling because of factors inherent to that market?
You know, it's quite amusing to hear the style in which you asked the question about oil prices. It's linked to what I said earlier. You know, usually a lot of countries, particularly oil importing countries, are worried about oil prices rising. So I would have thought oil prices going down is basically a transfer of wealth to consumers in oil importing countries. Really good for India, should be really good for Europe, should be good for the United States. So it's essentially good news. So yes, oil prices going down are probably a reflection of some weakness cyclically somewhere, but I suspect it's more of an ongoing consequence of the dramatically changing supply and demand for oil, and it's basically a good thing.
Where do you stand on commodities as an asset class? Are we close to the down cycle ending, or will 2015 also be a year of low and maybe falling commodity prices?
You know, I'm not sure. I suspect it'll be a bit more volatile, but again, if I really had to stick my neck out, I would be in favour of commodity prices dropping further. You know, I think if I look at the past 15 years, particularly looking at the world of BRICS, of course, of which is at the core of my professional life, it was quite easy for me to be really bullish for commodity prices the past decade or the previous decade until about 3 years ago, because at the core of it was this enormous growth of the BRICS, particularly China, and real problems of supply constraints. But we have China focused on a whole new style of growth based on quality and not quantity, and they're deliberately accepting of growth closer to 7 than 10. And you've got these incredible supply dynamics going on in oil, and to some degree maybe in some other commodities too. So I think we've seen the end of the commodity super cycle 2 or 3 years ago, and I think there are probably still too many companies and too many investors with positions built up on expecting a commodity bull cycle that I think is over.
Dr. O'Neill, thank you very much for joining us on all those issues. Well, that last answer of Dr. O'Neill, forecasting that crude prices are likely to remain soft throughout 2015, as well as definitely going to warm the heart of our next guest. Reserve Bank Governor Rajan was in Washington, and he spoke with Steve Leisman of CNBC. Here's a slice of that conversation.
What explains the volatility in your mind when you look around global markets?
Well, first, I think the biggest source of volatility nowadays is expectations on what monetary policy is going to do in reaction to events. Is the U.S. going to tighten more? What's going to happen in Europe, and so on? But of course, there's an underlying real economy also, and one of the biggest concerns is that the world economy is not picking up. The IMF has downgraded its forecast repeatedly. We've seen Chinese growth slow down. We've seen Japan not picking up after the tax rate rise. We've seen Europe in a very bad way. Italy actually has negative growth. France is not picking up. So big parts of the world economy are not growing, even while the U.S. is picking up. So the question is, can the U.S. lift them out? What does monetary policy in the U.S. do if the U.S. is one of the only places strengthening?
How important is that for the world that the U.S. is able to sort of reach escape velocity? What if it doesn't?
It's extremely important, and we're all hoping that the U.S. is there. Unfortunately, every year, at the beginning of the year, we think the U.S. is going to go 3.5%. By the end of the year, it's down to 2%. We're thinking again next year will be 3.5%. Let's hope it does happen.
One of the things I thought I knew about monetary policy was that central bankers, they couldn't pick an unemployment rate, but they could pick an inflation rate. I look around the world today and I see key central bankers losing this war on disinflation or deflation. They can't seem to get the inflation. What's going on in the world, in your opinion, that these inflation numbers keep coming in lower while they keep putting on the accelerator more when it comes to monetary policy?
Well, essentially monetary policy has limits. If every time you press the accelerator, you pump more reserves into the economy, but banks are willing to hold those reserves without actually lending, without increasing credit, then monetary policy is actually pushing on a string. I think in many countries we are in that situation now, so we are losing the ability to get traction on inflation. Of course, we in India don't have that problem.
Completely different problem. I want to talk about India in just a second because it's astonishing how different it is from the rest of the world. But I want to just focus on the globe for one more question here. This issue of monetary policy and the ability to get traction and get out of the current trap that they seem to be in right now. Do you think that Europe and Mario Draghi has the ability to get the right policies in place, or are the politics just too difficult?
Well, I don't know. I think Mario Draghi has bought time for Europe, but the political system has to take that forward through the reforms that are needed in country after country. And what we have to wait and see is, can Europe use the time that the ECB has bought for it wisely?
Getting now to India, one of the things you've spoken about is your concern about U.S. rate hikes. Is it still something that concerns you and the effect on India? And you've also said that we no longer have international monetary policy cooperation. Is that still true?
Well, first, we were hit by the taper tantrums in July of last year. But I think since that, we've had two other episodes. In January, when Argentina had some problems, emerging markets faced more problems. India came through that fairly safely and stably. August, again, we had turmoil in emerging markets. India, again, was relatively calm at that time. So my sense is we are in a much better situation relative to then, because there have been major changes in India's macro stability. We've got a lower current account deficit, lower fiscal deficit, lower inflation. There's more confidence.
So what's your inflation rate? Because people aren't going to believe that. What is your inflation rate there?
7.8% as of the last count.
Everybody else is near zero. You have 7.8%.
Yes.
But it's been coming down.
It's been coming down.
And people are beginning to believe that sometime next year you're going to cut interest rates.
Well, they believe that. I can't enlighten them on that right now, because what we've said is we're well positioned as far as reaching our target of 6% by the end of next year goes. But if the data come in more friendly, we'll be in a position to cut rates. If they're more hostile to our inflation targets, we'll have to raise rates. So we're data dependent, as the Fed puts it.
Prime Minister Modi is a huge sensation here in the United States, around the globe. He's been thought to be very, very pro-business. When you look at his policies and what's happening, what kind of effect does it have on central bank? What is your view of the effect it'll have on the Indian economy?
Well, first, I think the fact that we have a stable government is a very big plus for India. There was a lot of political uncertainty that has been removed by the vast majority that the government has. Second, it's a business-friendly government, and it's working at the micro level, clearing out the regulations, making it more business-friendly as far as, say, taxation goes, giving more clarity on taxation. So the number of places where they're trying to improve the business environment, they have a goal of bringing India on the World Bank scale down from 130 on how easy it is to do business to the 50th country on that list. So that's an admirable goal. Let's see how it works out. But action is happening, and that makes our job much easier.
Right. Let's take a break on that note. Thereafter, Morgan Stanley has a super optimistic view on the reform agenda and India's ability to implement reforms. That report and its author after the break.